The RBA has just increased interest rates by 0.25%, and while that may create a little bit of short-term uncertainty around the market, today I wanted to address some of the fundamentals in the Australian property market which will keep it buoyant and heading in the right direction throughout 2026. Now, I think the biggest shock about rates going up is we've been hearing for a long time in Australia that the most likely move will be steady or even potentially down. Now, I think the rate hike was based on two things. One, they're saying the underlying level of inflation is obviously a little bit higher, but when we look at the monthly and the annual capital growth rates in a moment, you'll see just how strong Australian property is going, and one of the levers that they can pull is pushing rates up a little bit to stop some of that speculation. I think the most important thing to understand as an investor this year is we are now in a two-speed market. And what that effectively means is there's these markets going absolutely ballistic that have done extremely well in the last 7 or 10 years throughout the country. And then there's these markets that are actually in complete opposition to this that are just chipping away, where there's not as much hype or as much short-term growth at the moment, that haven't done as well in the last 7 to 10 years. And while most of the media outlets will have us believe that the ones cranking are the ones we should be buying in, I'm actually taking the counter-secular approach to that and using the data to drive the decisions that I make this year. Now, when we look at the fundamentals around the Australian market at the moment, one of the biggest issues we have is this supply to demand ratio relationship across the country. Now, some markets are building so much product right now that they're going to be completely oversupplied within 5 to 10 years from today, where other markets are massively undersupplied. Now, the easiest way for you to see this as an investor is to look at the total number of people moving into an area versus the number of building starts. Another great way is to look at the rental vacancy rates. And there's a number of markets around the country, which I'll get into a moment, with a vacancy rate sitting below 1%, which means they are chronically undersupplied. Now, the three things that ultimately drive property price growth and speculation across the country, regardless of what everybody says, is long-term growth rates versus short-term growth rates. Obviously, you want the markets that have a great long-term history that haven't done as well recently. On top of this, another main lever is how easy and how cheap money is to get. So interest rates play a big role. But the most important of these, and the least talked about online, is this idea about affordability. Now, what drove Wollongong and Newcastle nuts about 7 or 8 years ago was it was so cheap. The same thing happened in the Gold Coast and Sunny Coast. And that's also what's driven Hobart, Perth, Adelaide, Brisbane and Darwin over the last 5 years. Ultimately, there are investors like you and I that are always looking for value across the entire Australian market, but most people emotionally buy, whether they're homeowners or investors, what they know and what's affordable close to home. Now, when we look at the capital growth rates across the country over the month of February, as you can see here, Brisbane, Perth, Adelaide and Darwin are going absolutely ballistic. In fact, if Perth continues to grow by just 2% per month over the year, we're going to see around about 24% growth, which is phenomenal. As you can see here in the graph, there really is that divergence across the country, with half of it exploding and the other half underperforming relative to those. So Sydney, Melbourne, Canberra and Hobart are underperforming relative at the moment, with my favorite market in the country, which is completely anti what everyone else is thinking right now, being Melbourne, having the worst performance by far over the month of February as a whole. That said, Melbourne is not one market, and there are suburbs down there right now that are doing literally $10,000 or $15,000 a month in capital growth if you know where to look. Now, when we look at the average capital gains across the country's major capital cities over the last 12 months, you can clearly see Australia-wide, everything is in boom territory and everything is moving in a positive direction. Now, this is significantly different to what we've seen over most of the last 5 years since COVID, where a number of markets were going backwards or a number of them were sitting flat. It feels like now, with the massive amounts of people that they're allowing to come into Australia and the chronic undersupply of property across many of the capital cities, plus the fact that interest rates were stable for a long time and there's very high investment demand back in the market. In fact, the strongest investment demand that we've seen at any point in the last 5 years across the country. We're seeing all of the capitals do incredible gains. I'd be literally happy to have owned an investment property in any one of these markets across the country in the last 12 months. The reason for this is a 5% return may not look as sexy as what you can see there in Brisbane, Perth or Darwin at the moment, all of them doing sort of 15 to almost 20%. But if you were to go out there today and buy a $750,000 property and it did just 5% a year for the next 15 years, it would literally double in value and be worth as much as $1.5 million at that time. So even though 5% might not look super interesting on this chart right now, it is what can make you wealthy and free in the future. Now, while these numbers might look absolutely crazy to some investors that are more new to the market, when we look at the data in Australia, in Sydney, Melbourne, Brisbane and Perth between 1970 and 2016, you can literally see that every single one of those years, coloured regardless of market, meant that that city had a 10% plus growth year. And you can see when you look at bigger data sets, when you go back and look at the past, that 10-year growth years are actually quite common. And there's many, many data sets there, particularly in Brisbane as well as Perth, where we can see 10, 15, 20, even as much as 30% growth in a single year. So while things might feel like they're going absolutely off right now, with the perspective of history, we can make better decisions moving forward with our futures. Now, when we look at the vacancy rates over the last month, we can clearly see that the likes of Brisbane, Perth, Adelaide, and Darwin, which are the 4 markets that are going absolutely ballistic right now, are also the ones with the lowest vacancy rates. Now, a couple of years ago, I looked at about 20 years worth of data from Commonwealth Bank, and what they looked at was the relationship year on year for 20 years between capital growth rates and rental vacancy rates. And what I could see is the markets over that time that had lower vacancy rates achieved generally much stronger capital growth rates over that 20-year data set. Now, one of my favorite things to track every single month is consumer confidence, and this is based on the ANZ Roy Morgan report. And what I love most about Australians is the better gold, silver, or property prices seem to do, the worse we actually seem to feel. And the confidence score has actually dropped over the month of January, despite what's happened in Perth, Adelaide, and Brisbane, as well as all the other markets kicking ass right now. Now, while I do think it's funny the way that we interact as Australians with the markets that we're in, I actually think it's one of the things that saves us. We're not speculative like they are in America. We don't rush in and do silly things. The banks aren't allowed to just leverage up. And there's organizations like APRA that do responsible lending standards most of the time. And there's things like the RBA that are constantly looking forward. And while this interest rate rise may have been a little bit unpopular, and for me as someone with a whole bunch of debt, obviously from the properties that I own, I'm not loving the fact that it's going up. But according to the guys over there at CBA and in their CommSec report that they just released, they're saying this interest rate rise will have little effect on property price growth throughout 2026. Now, one of the most meaningful things I've seen change massively in the data set in the last 12 months is the relationship between who is borrowing money across the country. So historically, what I've seen from following this number for most of the last 10 years is about 70% of the loans being written across the country are for mums and dads, owner-occupiers, and about 30% for investors. But that number has changed dramatically in the last 2 months of doing this stuff, with investors now being about 41% of the total property buyers across the country. On top of this, talking to some of my friends as well as my colleagues that are in the mortgage broking business that write $100 to $300 million a year worth of new loans, they said the number of pre-approvals in place, particularly in Brisbane, Melbourne and Perth right now, are at unprecedented levels. So I think that's a really good leading indicator to see how many pre-approvals are being written, which will flow on to capital growth down the line for the markets where those loans are being written. Now, the last data point I wanted to hit this month is just the number of distressed listings. Now, again, it wasn't that long ago where we were all freaking out, or that COVID was coming through, or they were talking about the mortgage cliff where we wouldn't be able to afford to hold our houses anymore and everything was going to fall off a cliff. Now, despite all of those headlines over the last 5 years, currently distressed listings in Australia are down 31% from this time last year. So I think when I take a step back and look at the Australian property market from a big picture macro level, and why I had the confidence to just recently go out there and buy my first investment property for 2026, is the fact that population growth is insane. 160,000 people per year moving into Melbourne at the moment, with over 500,000 people coming into the country. And these aren't all refugees. A lot of these people are coming in with 1 grade income, 2 grade incomes. They're doctors, they're lawyers, they're accountants, they're engineers, they're essential workers, not just from Asia and India, but many, many people are coming back in from the UK again as well. On top of this, there are unprecedented amounts of government infrastructure spending at the moment finding their way into the hands of public companies. Commodity prices are going absolutely ballistic. Construction is still extremely strong. Unemployment rates are low. Incomes have jumped. Many people out there and many investors have made great money off their own homes, investment properties, gold, silver, other commodities, the stock market, bonds, or even in their term deposits in the banks over the last 5 years. And what I think we'll see over the next year to 18 months is much more of that money wash through the Australian economy, which is why the likes of Domain, realestate.com and SQM Research are expecting an extremely strong year, with markets like Perth expected to do as much as 16%, Brisbane expected to do as much as 15%, and Adelaide expected, as well as Darwin, to do incredible things as well. So if you, like me, are looking to buy one, maybe two extremely high quality properties this year in the most undervalued markets and suburbs across the country, then I'd love to offer you a one-on-one strategy session. To book that, simply jump over to www.pumpedonproperty.com, click that free strategy session button. We can talk about exactly where you are right now. We'd like to be longer term, the pros and cons in the market right now, and what's really going on data-wise. And you can take that information and go and smash it on your own, or potentially become one of the extremely small number of clients that we choose to take on each week. But either way, we truly wish you all the best for 2026 on your journey to financial freedom.